Let's bring in the analyst behind the call. Wolfe Research's Peter Supino. Peter, hard to kind of like pick through the wreckage right now, but is that partly what led to your moves here? Welcome.
Yeah, I like the way you introduced our call this morning, domination and valuation. And yes, it's a really tough day to even think about buying consumer discretionary stocks. The timing of this upgrade on a day-to-day basis was about our media preview, which spanned our entire coverage. And we've decided that Disney is closer to go time, so to speak. Disney is a company that has many things going for it at the same time as it's facing real serious economic headwinds. And so we're focused not on what happens after the recession. And there's a few things going on. The streaming business, we think is worth about $35 a share and contributes nothing to profits today, will contribute in the future. And Disney's launched 3 new cruise ships that should contribute $800 million over the next couple of years.
Can we go back to the part where you said we're looking at what happens after the recession? Is that, I mean, should we now, and a lot of people are saying this, and maybe it's true, but it's still something, I don't know, I don't like the idea that it's basically inevitable at this point.
Well, I'm not an economist, and I'm listening to the same voices you are. And it's much easier to start a conversation with investors about Disney by level setting on the idea that maybe we'll just have a recession, and then what? Yeah. Disney is one of the stocks that's pricing in a very high probability of a recession. For example, we think in the case of a pretty harsh recession, Disney would earn $4.70 per share. The company's guided to $5.50 for 2025. At 83, with the stock having been 115 2 months ago, we think that downside's already priced in.
I appreciate that, you know, and I can take your point. Instead of arguing about whether we will or we won't, you just say, okay, so we do, and then what? And what about with Spotify?
So Spotify is the exact opposite of Disney from the stock market perspective. Spotify and Netflix have in common that they're utility-like subscription businesses. They charge consumers small bills that consumers pay without thinking about it every month. And consumers get a ton of value from these products. The cost per hour of engagement at Spotify is something like 25 cents for each consumer. The cost of an hour of engagement at Netflix is just about twice that, in the 40-cent range. So there's a ton of value here. This is the last thing a consumer is going to cut. And their growth outlooks, Spotify's growth outlook is just so idiosyncratic. They have a 30% share of global music streaming, which probably has an addressable market of 1.5 billion people based on the number of smartphones in people's pockets around the world. So we think this is going to continue to compound.
And finally, the rest of your group, I mean, there's a lot of names in here that are kind of, they include our parent company, Comcast. You've got, you know, some of the tech TMT names in here, like T-Mobile, Verizon, AT&T, some of the music, some video game, live entertainment. How do these all shake out in a recession that people now kind of want to take as a base case?
Well, you've seen it in recent stock price action. The advertising and travel/theme park related businesses like Disney have all traded really poorly in the last several weeks. The distinction we make on these cyclicals is there's a type of cyclical you want to own on the backside of the cycle, and that's a theme park. It's a company that has a business that has real high visibility on recovering its normal profit margins and revenue levels. An advertising business, a linear TV advertising business, is just the opposite. You don't know what you're going to own on the other side of the cycle. Elsewhere in our coverage, telecom has traded very defensively. There's been a lot of, I think, flows into that sector that have kind of rediscovered it in the last year, and now it's getting a benefit from the weak stock market. And of course, the streaming names like Spotify and Netflix are the perfect storm of positives. I guess that's misusing the metaphor perfect storm, but they're both visible and growing in a very unique, independent, uncorrelated way.